Your next reading is inventories, and these are the specific learning outcome statements in this reading. We will discuss briefly all of these, starting with the first one. Distinguish between cost included in inventories and cost recognized as expenses in the period in which they are incurred. This is the tabulated detail. What is included as a part of product is the purchase price of material, what you pay, including all the custom duties, freights, etc. Deduct discounts and rebates. This would be the net purchase price of the material acquired. The transportation is also added to the purchase price. Then we add the conversion cost. Conversion cost is the direct labor incurred in converting that raw material into finished goods. Manufacturing overhead are all the indirect costs incurred in the factory. Normal wastage. In production processes, some wastage is expected. Some wastage is a part of production process, like if 100 units are input, 5 units are normally wasted. So the wastage rate or the spoilage rate is 5%. So this wastage is considered as a part of product. But anything above 5% is considered as an abnormal wastage. Any material, labor or overhead incurred on those spoiled units, it is considered as an expense for the period, not as a part of product. Storage cost for raw material, storage cost for work in process, all are capitalized, all are included as a part of product. And any other necessary cost that is needed to bring the inventory to their present condition and location. So all these are considered as product cost. And the cost to your right, storage of finished goods, production process is complete. It is not a product cost. Administrative cost, goods are completed. It's not a part of product cost. Selling cost, distribution cost, all these costs are incurred and considered as an expense for the period. And these costs to your left, these are considered as a part of product. There's a much better table given here. This will explain things in much clearer way. The cost to my left, given in yellow, they are all product costs. Acquisition price of material, including transportation in, less any discounts, rebates, direct labor, the effort, the human effort incurred or applied to the product, to the raw materials to convert them into finished goods. Normal spoilage, that is considered as a part of production process, given in green. These green represent they are included as a part of product. These are excluded. So it means these last three are not part of product. Variable overhead, these are the overheads in the factory that vary with the level of output. Electricity, gas, water, indirect material, indirect labor, all those costs vary with the level of output. It's called variable overheads or variable manufacturing costs. Then we have another set of costs called the fixed overheads. Fixed overheads includes rent of the premises in which the production is taking place, rent, insurance of the building, manufacturing facility, insurance of machinery, depreciation of machinery, depreciation of, in other words, all the fixed costs in the factory. Depreciations of facilities, machinery, insurance, property taxes, plant manager salary, plant supervisor salary, they are all considered as a part of fixed overheads. And it is included. Warehousing of your raw material and work in process, it is also considered as a part of product. Now these costs given, these three are excluded. Warehousing of finished goods, once the goods are completed, it's not a part of product cost. It is considered as a period cost. Administration and selling cost and abnormal spoilage, as we already discussed, it is not an expected loss, so it must be considered as a loss for the period. Normal spoilage is considered as a part of product cost. So these are the specific costs that are included as a part of product, and these three are excluded. Your next LOS says, describe different inventory valuation methods or cost formulas. These are 4 cost flow assumptions: specific identification, first in first out, weighted average, and LIFO. Remember, US GAAP allows all these 4, but under IFRS only the first 3 are permitted. LIFO is not permitted under IFRS. What they are all about we'll discuss in detail in our later slides. When we say first in first out, they are both acceptable under US GAAP and IFRS. Assumption for FIFO is the items first purchased are to be sold first or are to be issued to production first. First in, first out. It means when the items bought first are issued to production or used or sold out to customers, it means your closing stock will be from the most recent purchases. LIFO is only allowed under the US GAAP. It is opposite of FIFO. Under LIFO, last in first out, the items that are purchased latest, they are issued to production or they are sold first, or that cost is charged to CGS, which means your CGS will be composed of the latest cost and your inventory will be from your earliest purchases. And then there's third method, weighted average. Weighted average is it's a midway house between these two. Items sold are a mix of purchases, so you get an average cost for your CGS and average cost for your ending inventory. We'll discuss this in detail. So what next? Same thing. It's the third LOS now. Calculate and compare the cost of sales, CGS, gross profit, and ending inventories using different inventory valuation methods and using perpetual and periodic inventory system. Your inventory cost, which we consider direct material, direct labor, variable overhead, fixed overhead, all the related cost of keeping raw materials and work in process, it is considered as a product cost. All this cost will be an asset as long as the inventory is with you. The moment the fixed good, your finished goods are sold, the cost embedded in the inventory, the whole of it, is expensed. So inventory cost is an inventory as an asset as long as it's with the business. As soon as the finished goods are sold, your inventory becomes cost, and this is called cost of goods sold. Now let us see these cost flow assumptions one by one. Specific identification, FIFO, LIFO, and weighted average. And before we do that, we need to differentiate something between perpetual and periodic inventory system. Perpetual inventory system takes into account every purchase, every sale, every receipt, every issue. Perpetual inventory management system is updated all the time. Every purchase we make, every sale we make, inventory records are updated immediately. It provides most up-to-date cost and sales records. In other words, every sale you can calculate profit on each item sold because we have the data comparative on perpetual basis. So perpetual system, data is updated after every purchase, every sale, every receipt, every issue. This system, which is updated after every transaction, is called perpetual system, which is always updated. This is what is used in the modern inventory management system. But in the periodic system, the Desi system, ending inventory and CGS are determined at the end of the accounting period, a quarter or a week or a month or the year. We physically count the goods and then the difference is determined as goods sold, and whatever remains with us on hand is considered as the closing stock. So for this system, we have to wait till the end of the period, but under perpetual system, your records are always updated. You get your updated information regarding CGS and sales after every transaction. Then, specific identification method. Where and when this method is applied? When units are sold and these items are so distinct from each other that they can be separately identified. So their cost can be separately traced. Each item's revenue can be matched against each item's cost. So when this is possible, such a system is called specific identification system, in which we have specific separate costs for every item. So CGS and the revenue can be compared for each item separately. This is called specific identification. How does it work? Let's say these are our units in the opening work in process. We bought these units at these dates. Out of these, we sold 1050 units, and still there are 1200 units in the closing stock. Under specific identification, we will know exactly that when we sold these 1050 units, they were sold out of which specific purchases. Right? Under specific identification, items can be specifically identified which item is sold against which receipt, and ending inventory can be specifically identified. This is called specific identification method. Then we have the first in first out. As the name suggests, your initial purchase is the oldest cost, oldest items. They are issued to production first or they are sold first. They become the part of CGS first. Your latest buying, latest arrivals, recent cost, latest material, it becomes your past or part of your ending inventory. This system is called FIFO. This system is permissible under the IFRS as well as the US GAAP. Now, under FIFO, these 1050 units sold, these will be sold from your oldest purchases. Your closing stock will be composed of your latest buyings. Under LIFO, your recent purchases, latest arrivals, your recent cost, they are charged to CGS. Recent cost charged to CGS means your CGS will reflect your current prices. And your oldest cost, oldest inventory, it will be considered as a part of ending inventory. So your CGS will reflect the latest cost, your ending inventory will reflect the oldest prices. So you can say that your revenues will be matched against the latest CGS. So income will be presented on the most recent cost versus revenues. Whereas the inventory will be on the oldest cost, the items which we bought at the earliest prices. Remember, LIFO is only permissible under the US GAAP and it is not allowed under IFRS. Now, if we are using LIFO, so these 120, 1050 items sold, they would have been sold from your latest buyings. Your closing stock will be composed of the items which we purchased earlier. Your closing stock will be from your earliest buyings and your CGS will be on your latest costs. Weighted average takes a midway house. It will calculate a weighted average for all the goods bought during the period, and this weighted rate will be used to value your CGS. 1050 units were sold. The CGS can be calculated by the average rate. This will give you the CGS, and closing stock can be calculated in the same way. Closing stock will also be valued at the same average rate for the period. Now, in putting all these numbers here, we can calculate the gross profit under all these systems, and as you can see, highest gross profit is under the system which has the highest closing stock. Look at this. This is the value of the highest closing stock. This one here, merchandise inventory. 6695. The gross profit is highest for FIFO, whereas for LIFO, it is 19100 because the closing stock was 6310. In between these is the weighted average 6512, so the gross profit is between these two numbers. So an important conclusion we can draw from here, the higher the closing stock, this closing stock will be deducted from CGS. Your CGS falls, lower CGS will feed into your overall trading account, and your gross profit goes up, your net profit would be higher as well. Right? So this was the comparison. Now next, reading, calculate and explain how inflation and deflation of inventory cost affect the financial statements and ratios of companies that use different inventory valuation method. When the prices are increasing during period of inflation, if you use LIFO, when the prices are going up, last in first out will charge your highest prices to cost of production. Resultantly, your cost will go up. When your cost goes up, your gross profit will fall. And since latest purchases, highest prices have been charged to CGS, your older, lower cost will be reflected in your ending inventory. And if there is a period of deflation, you will see the exact opposite. Highest, lowest, and highest. Under FIFO method, when the prices are increasing, first in, first out. When the prices are increasing, you will charge your older costs, lower cost to CGS. Resultantly, your CGS will be lower. When CGS is lower, your gross profit would be higher because they move in the opposite direction. Since the oldest cost, lower costs have been charged to cost, your latest prices, higher prices, they will be composed of your existing closing stock. So your closing stock would be higher. And you can do it totally other way around to see the impact of deflation. When the prices are increasing, you will have lowest here, highest here, and lowest here as well. Now, a comparative analysis of inventory under IFRS US GAAP. Let us see it one by one. FIFO is allowed under both systems. Average cost method is allowed under both systems. LIFO is not permissible under IFRS. Yes, it is allowed under the US GAAP. NRV rule you will discuss in our later LOSs. NRV rule is applicable on all bases under IFRS, but NRV rule under the US GAAP, it is applicable to all except LIFO and retail method. Under LIFO and retail method, what is retail method? I'll just tell you fleetingly. Let's say if your goods in inventory is $100,000 and there is a gross margin of 20% on all the items we sell. So if you want to calculate the closing value of these goods which are at retail price. So you deduct this profit 20,000 from it, what you get 80,000. This is the cost under the retail method. This is not a part of your syllabus discussed in CP and CMA. So if your inventory is valued under LIFO and retail method, then for that we have a separate rule, LCM rule. We'll discuss it later. And for all other bases, you will use NRV rule. So this is an important point. LCM rule is applicable on LIFO and retail method. And for all others, you will use the NRV rule for inventory valuation. Under IFRS, inventory reversal is allowed. In one period, if you write down the inventory, subsequently if the NRV goes up, reversal can be done, but not more than the previous write down. Under US GAAP, once inventory is written down, the reversal in the subsequent period is not allowed. Admin and selling expenses and abnormal spoilage, they were already discussed that they are not part of production, so they're excluded. This is your LOS 4. Next LOS says convert a company's reported financial statements from LIFO to FIFO for purpose of comparison. Since some companies in the US may adopt LIFO, and LIFO is allowed under the US GAAP, so if we have to convert those financial statements into FIFO base, these are some formulas we need to know. And before that, we need to understand something about LIFO reserve. LIFO reserve is the difference between the same inventory valued under FIFO and the same inventory and valued under LIFO. This difference between FIFO and LIFO inventory is called the LIFO reserve. So what is LIFO reserve? The amount by which LIFO inventory is less than the FIFO inventory. Since prices are continuously increasing, so your FIFO based inventory would be higher. How much higher than LIFO? That's the difference called LIFO reserve. So when the prices are rising under LIFO, your LIFO inventory will be less than FIFO. I just told you. FIFO inventory will be higher than LIFO. Since your closing stock under FIFO is higher, hence your CGS under LIFO would be higher, under FIFO would be lower. Because closing stock, whenever it is higher, your CGS will be lowered. Since FIFO inventory is higher, this higher closing stock will reduce the CGS, and that's the reason CGS under FIFO is lower, under LIFO is higher, and conversely, the profits will move in the opposite direction. Whichever system has higher CGS will have lower net income, and whichever system has lower CGS will higher net income, and accordingly the same impact upon taxes and retained earning, which can be construed in the same flow. So this is how we can convert our LIFO based data into FIFO. If we have been given the LIFO inventory, we can convert LIFO inventory by adding the closing LIFO reserve. The closing LIFO reserve means the closing difference between the FIFO inventory and the LIFO inventory. Adding this closing reserve will give you the FIFO inventory. If you want to calculate the FIFO COGS, FIFO cost of goods sold, you will take the LIFO cost of goods sold. From this, deduct closing balance and opening balance of LIFO reserve. Their differences will be netted off against CGS. It will give you the FIFO CGS. I'm just skimming through the ideas because we have extensively covered 93 MCQs related to it. Everything was discussed in those MCQs. Every single bit was there. Everything, even including the journal entries for these. So that's why I just need to rush through it so as to focus on more EOC questions, because there are lots of questions to be done. Then we had FIFO operating income. FIFO operating income can be calculated by taking your LIFO operating income and to it adding change in LIFO reserve. Cost move in the opposite direction. That's why you see a negative sign here, COGS. Income is in opposite direction, so you see a plus sign. Rest of the dynamic is the same. Change in LIFO reserve, change in LIFO reserve. But if we need to calculate the net income, which is of course after tax, the dynamics stay the same. LIFO net income plus, but this time change in LIFO reserve has to be taken after tax. Why? Because net income is after tax, so your change in LIFO reserve must be after tax as well. Same goes for the retained earning. Retained earnings, FIFO closing is LIFO retained earning, and to this simply take closing LIFO reserve times 1 minus tax. Since your LIFO based profit would be lower, resulting in lower tax, when we convert into FIFO based, there will be more tax on FIFO based because the income under FIFO will be higher, so it has to be adjusted for tax purposes as well. So closing LIFO reserve multiplied by the tax rate, this will give you the increase in tax rate as per the FIFO system. And this increase in tax will be reflected by reduction in cash. Your cash under FIFO will be lower by this extent, LIFO cash time tax rate multiplied by the LIFO reserve. So this will give you the FIFO cash to be lowered, and this will give you the increase in tax compared to the LIFO. So these formulas, you can take the snapshot, or I'm sure you would have written it somewhere yourself. You will need these while you will be converting our LIFO based financial statements into FIFO. and we are flying. Next LOS relates, I think still continuing LOS 6. The LIFO reserve will increase whenever prices are rising. Why? Because we know LIFO reserve is the difference between your LIFO inventory and your FIFO inventory. So whenever the FIFO inventory minus LIFO inventory. So whenever the FIFO inventory goes up, whenever prices are rising, the gap between the FIFO and LIFO goes up, so your LIFO reserve goes up as well. So LIFO reserve will increase when prices are rising and inventory quantities are stable and increasing. If a firm is liquidating its inventory, selling more than when it buys, or if prices are falling, LIFO reserve will decline, opposite to the first one. This brings us to the idea of LIFO liquidation. If a company sells more than what it buys, LIFO liquidation will occur. LIFO liquidation occurs when LIFO firm's inventory quantities decline. We sell more than what we buy. Older, lower cost items, because prices are perpetually increasing across the world in every market. Normally, that's what the case. So older, lower cost are included in CGS that are being released. We are selling more than buying less. Resultantly, it will result in LIFO liquidation. This would result in lowering of LIFO reserve as we sell more units. So LIFO liquidation results in higher gross profit. Why? Because you are charging lower CGS to your cost of goods sold, and this lower CGS will eventually in trading account will increase your gross profit, eventually increase your net income and retained earnings. So LIFO liquidation results in higher profit margins and higher income taxes compared to what they would be if inventory quantities were not declining. Next, we have LOS describe the measurement of inventory value at lower of cost and net realizable value. Under the US GAAP, LCM rule is only applicable if the cost flow assumption is LIFO or retail method. Now, what is LCM rule? In LCM rule, please note it down. You will compare two things. First, you will take the cost, which could be LIFO cost or the retail method cost. You will compare it with the designated market price. What is the designated market price? It is middle number of these three. You will take three numbers and the middle of this will represent the designated market price. This designated market price versus the carrying value, the cost, this will determine which of the values we will take for writing down. These three numbers first will be called your NRV, other will be NRV minus normal profit margin. They were all there. All these questions were there in those 93 questions. And the replacement cost. You will write these NRV as a first circle, your replacement cost as the second, and NRV minus normal profit margin as the third circle. Whichever of these is the middle number. Highest and lowest are to be ignored. The mid number, it could be any of these. It could be NRV, replacement cost, or NRV minus normal profit margin. Whichever of these is a mid number, take that mid number as a designated market price, compare it with the cost. Whichever of these is lower would be the base. If the cost is lower, do nothing. There is no impairment. There is no write down needed. But if your designated market price is lower than the cost, then inventory had to be written down. And once written down under the US GAAP, the reversal is not allowed. This is called LCM rule. You compare the cost versus the designated market price. What is designated market price? I'm not going for the ceiling or the floor. The normal textbook says so. This is the method we use in our conventional financial reporting in CMA. We take these three numbers, RV, NRV, which you know, final selling price minus cost to complete and sell. Replacement cost, NRV minus normal profit margin. Take these circles, take the mid circle, the number that is middle of these. Neither too high nor too low. Whichever of these is mid, compare it with the cost. If cost is lower, keep the inventory at cost. If market price, the middle of these is lower, take that as a new base. The difference will represent the diminution in the value of your inventory, which will be written down through valuation allowance, and this loss is not allowed to be reversed under the US GAAP. Other than LIFO or retail method, whatever inventory method, whatever inventory cost flow assumption you have adopted, for that we have an NRV rule which is applicable both under US GAAP and IFRS. What you do, you take cost at one side, you take your NRV on the other side. NRV is the final selling price minus cost to complete and sell. Whichever of these is lower, that would be the base. If the cost is low, keep the goods at cost. If NRV is lower, then convert your items to NRV. The difference will be the inventory write down. Under IFRS, this write down can be reversed, but not more than the previous write off. But under the US GAAP, inventory write down reversal is not allowed. Under IFRS, inventory write-down may be reversed, but not more than the previous write-off. Then, describe implication of valuing inventory at NRV for financial statement ratio analysis. We know when inventory is written down, inventory value falls. Inventory falls, your current assets fall. When current assets fall, your current ratio falls. Current ratio falls, liquidity falls. Assets fall. When you write down your inventory, profit falls. When profit falls, equity falls. Right? Accordingly, how the ratios are impacted, we know the assets turnover is sales upon average total assets. Writing down inventory will lower the assets. Sales upon average total assets, assets turnover would increase. Debt to equity. Writing off your inventory will result in loss. Loss means lowered equity. Lowered equity means high debt to equity. Debt to assets. Debt upon assets. Writing down inventory will lower the assets. Debt to assets will go up. What will happen if the inventory is written down? In writing down, it will do the opposite order. Income will fall. Profit margins fall, return on assets will fall, ROE will fall. So you can do it. Just plugging in the numbers in numerator and denominator, you can just develop the understanding from the numbers, from the situation itself. Next, describe the financial statement presentation and the disclosures relating to inventories. What are we required to disclose in financial statements? Which cost flow assumption did we use? LIFO, FIFO, what? To be disclosed in notes. We need to split our inventories into raw materials, that is the material that will be used in production. Some goods are partly finished. These goods are called work in process. They are valued differently under cost management. That's not the subject of CFA. Finished goods, the goods that have been completed. So we need to split our inventory and show them in three categories: raw materials, work in process, and finished goods. Some inventories are reported at fair value, less selling cost, especially under IS 41. Certain biological assets, agriculture products can be reported at fair value, which could be higher than the NRV. Inventory write-down, if written down, the circumstances of the write-down needs to be given in notes. And as I said, reversal is only allowed under IFRS, Murphy reversal in the US GAAP. And if any inventory is pledged or hypothecated for any loan, that needs to be disclosed in notes as well, because inventory may be used as a collateral for loans. This is frequently done by business for working capital finance, for credit lines. Next, LOS explain issues that analysts should consider when examining a company's inventory disclosures and other sources of information. If your finished goods is building up, what does it mean? It means that finished goods are increasing, but sale is falling. It means it would result in future write-off of inventory. Sales are falling, the business expecting a downturn. Swelling finished goods inventory represents the future problem for the business, future write-offs. Dwindling sales demand. But to the opposite side, if your raw material inventories are increasing, work in process increasing, this would indicate that the company's sales demand is increasing. So we can expect a higher future earnings in the business. Then we have calculate and compare ratios of companies, including companies that use different inventory methods. These are in fact all contextual. There are many ratios which you have discussed in your previous reading, financial statement analysis, inventory turnover, etc. So we just need to write down the formula and put the numbers there, or just use some assumptions. We can do right on spot, so could be quite long debatable area. So we'll just do it there and then when it's needed. So that completes your LOS inventory.